Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's take a dive in, see what people are sharing. If you want to follow me, it's at Financial Finance, and if you want to join our community, finding-value.com. We've got a platinum question and answer session later today at 6:30 p.m. Mountain Time. It's 90 minutes delayed for something that I had to do. Um, so if you want to join, you can use the discount code DISCOUNT, $10 off the first month, and first month only, and you get a larger discount on the yearly membership if you'd like to join and attend those question and answer sessions or watch them on the website afterwards. We're going to go with John LaFleur, however you pronounce his name. This isn't getting enough attention. The lowest number of home sales since 1995, when the U.S. was 80 million fewer people. The market is totally dislocated. Either rates have to come down despite persistent inflationary pressures, or house prices have to come way down. Add to it all-time high housing starts, all-time high inventory, 7,000 boomers dying daily. They own 40% of the homes. Well, I mean, looking at his data and knowing what the data is behind it, we're going to share a little bit of that data behind it. I'm going to say he wins the short bus, riding the short bus game here. this this is this is definitely not good investigative skills, and actually looking at the data or looking at all of the information that is needed to make statements that he has made. So he wins the short bus ride of the year. Here's some of the data. Smart Real Estate Bets comes in saying, do you enjoy spouting crap that has no semblance of the truth? Or are you just pitifully misinformed? And again, I give him the crown of the short bus of it. Housing starts were nowhere near all-time highs in 2024, actual data. As for inventory, a picture is worth 1,000 words. The two is better than one. So here is your U.S. homeowner vacancy rate from 56 to 2024. This is the actual data, not the misinformed short bus people walking around saying that there's this gigantic housing bubble. But the actual data says that we're in a crisis. And this is vacancy rate by percent. So what this is stating is that we have a huge problem in the housing market. It's at crisis levels. Not like we've got the vacancy rate up around 2.5%. So someone who can read data, interpret data, and then take data from maybe 15 different pieces, piece it all together. This is one of the most important ones, is homeowner vacancy rate. So you can't be at all-time high inventory levels, which we don't have, and be at a crisis level for vacancy rate. It doesn't make sense. And that's why I've awarded the Short Bus Award to this guy. Also, this is your single-family existing home supply or your inventory. This is in months of inventory. We're at 3.8. At 3.8 and the inventory levels that we have today, it is lower than any time in history going back to 1989. So again, I have to award this guy the Short Bus Award for not knowing any of this information. So this is home supply all the way up at around 10 months back in 1989 and 1990. This was a recession. Another recession was in 2008. A lot of these recessions coincide with the real estate cycle. In the real estate cycle, whenever you get to about 8 months plus, that's generally when they start to cut back on the construction employment. You start to see unemployment go up, and that unemployment is coming from construction for the most part. And that's where your slowdowns come. The slowdown is a function of people being unemployed and the credit not growing. So people don't buy as many new homes here and expand the credit as fast during these cycles. So this is the down cycle, the up cycle, the down cycle, the up cycle. We are in an up cycle right now. And the reason that we don't see house prices going down is because we don't have any homes. that it's as simple as that. The reason we have higher housing starts is because we are trying to create the inventory that we lack. Now, the difficult part that is coming into this is that the affordability is having an impact from interest rates going up so quickly. And that affordability is having an impact on new housing starts and the new home inventory levels. Now, another spot that a lot of people deserve the Short Bus Award in the housing real estate market, which I don't know if it's just people who don't know how to read data. I don't know if they have lower IQs. I don't know what it is in the real estate market and why people gravitate towards the real estate market who don't know statistics and data. It's very annoying. But when you look at it, we have to increase our WIP. Our WIP is work in progress. We use this in manufacturing. Work in progress is the inventory that is held at these real estate areas. So they need to carry more work in progress if they're going to build more new homes to sell more new homes. And that is a function of how bad the current existing housing supply is. So what happens is they're not buying existing homes because not a lot of people are selling existing homes. So what a lot of people are doing is they're going and buying new homes. And the way that the home builders are selling the homes is that they're buying down the interest rate for the potential home buyer to move the house and to sell the new home to that buyer. So they are doing things to buy down the mortgage rates for the affordability for a potential buyer. And that's why they're selling more new homes and how they're increasing the inventory total stock of all this is through building new homes and then buying down those rates. Now, some people say, well, it's like cheating. It's not normal market forces. Well, if if we had interest rates, or I should say mortgage rates, that were a lot lower, I think they would move all their inventory of those new homes. We could also see a little bit of existing homes being sold, but if the majority of people only own one home, that means that they have to move into another home. So you're just playing the swapping home game in existing inventory. So it's not a function of people needing to sell. It's a function of how many buyers you have versus how many homes you have for sale. So just because someone has to sell a house doesn't mean they don't need a house themselves again. It may be a different looking house. It may be a larger house or a smaller house, but it's still nonetheless a house. So what we need is we need to increase the inventory stock, so to speak. Here's more data. Home loan bill says, let me help you out, Johnny. 7,000 boomers are dying, yet 13,000 people are turning 35 per day. So that's the gap. So a lot of people, they look at one metric. Oh, the boomers, they're passing away and they're going to pass, and their homes are going to come onto the market, but they don't look at the demand. There are more family formations, more people and more home buyers than there are people who are dying on the back end. That is what people are missing. They don't understand data, apparently. Here is the graph. You can see that there's a lot less people on the right-hand side than this gigantic move upward. Now, there could be a move lower, or sorry, there's less here than this. There are home buyers. So these people who are passing away on the left-hand side are way less than the people that are coming on. But there is a little bit of a decline after this bulge that comes through for the next probably 3, 4, 5 years, whatever it is. And it also depends on the age of the first-time home buyer. I know that the age of the first-time home buyer has been increasing. It's greater than 35 right now. I think it's more towards 40 that age has moved up recently. So this may extend out a little bit further into the future than what we currently have seen in the past. Power demand on the largest U.S. grid is poised to surge thanks to AI boom. PJM interconnection, which manages the 13-state system stretching from Washington, D.C. to Illinois, expects peak summer demand to jump by 38% by 2035. I was just looking at this graph here. It says AI supercharges power demand growth, PJM summer peak demand, and it is rapidly increasing from 2024 all the way out to mid 2030s, it looks like, early 2030s. And then we get a little bit less of a demand increase. Now, I'm playing my investments off of not just AI boom, but the boom for electricity. Electricity generation and the transmission of electricity. And we have to build around the entire world a lot more transmission of electricity and generation of electricity. We can play that with the minerals and the commodities that support the installation of all this stuff. Also, the shipping of all of it. So I think that everything in the future is going to be a lot more mineral intensive than it is in the past. So as time progresses, our mineral intensity is going up and up and up to generate power and to transmit power. It's going to be far greater than what it was in the past. We didn't need to transmit as much electricity if we're burning natural gas or oil or diesel or gasoline or any of those things. If we are burning less diesel, gasoline, and natural gas in the future, out of ways, we're going to have to generate more electricity and transmit more electricity in the future. I think that those are going to be great locations or spots to be invested in over what I think is going to be a gigantic bull market in commodities and even precious metals. Ryan says, love this from Wealth OFC. It says, over the past 15 years, our economy has been in a recession for only 2 months. Now think how much time has been spent worrying about it, and then look at the previous times of the percent of time spent in recessions: 36%, 45, 42, 44. 16, 15, 9, 22, 18, 7, 22%, 0 in 2010s, and 3% in 2020. I do think that they're messing with the numbers too, though. Ever since the 1913, that's when the Federal Reserve was created. And then on this side, I think some of these areas, specifically past 1980, they've been messing with the numbers greater and greater. We can see that with there's a big gap between inflation and the way that inflation is being measured since 1980. They changed their metrics in 1980 of how they calculate inflation. They do substitutions, hedonic adjustments, and we can also see that the time spent in recession per decade has, quote, gone down. But I also think there's a large component in that for understating inflation. If you understate inflation, it means that those dollars go to the top line and they overstate GDP. And I think there's probably a lot of times where we are in a slowdown or recession that showed that we were growing, but it wasn't actual growth. It was just the increase in money supply and the understating of inflation. That's what I think is occurring. Martin, it says, laugh out loud, Trump. The American Petroleum Institute wrote to the U.S. Trade Representative to ask that tariff-free status for vital Canadian oil under the USMCA be maintained, effectively arguing for a carve-out from Trump tariffs. So, new tariffs on crude oil, natural gas, refined products, or critical input materials that cannot be sourced domestically would harm affordability, competitiveness, and the industry's ability to operate effectively. So that's what is being sent to him, and hopefully he considers that, takes it into consideration, and acts on it. I don't think we should be. I don't think we should have any tariffs on anything that is a critical mineral to America. That's my take. Doesn't mean it is worth anything, but that's what I would do if I was in charge. And I would really look to see the whole tax structure. I mean, if I was in charge, I would try to eliminate an income tax and the Federal Reserve, but that's me. That's what I would go after first. Then after that, then you can look at other things. But anything that's a critical mineral that sustains or improves someone's life in America is something I would not necessarily tax all that much. Rory says oil going to 50. We've heard these people where oil's going to $50 or oil's going down, and that very well could be the case. But this is kind of what we're seeing. It says for this to happen, you either need much faster supply growth, which is currently decelerating, or slower demand growth, which is currently reaccelerating. So which is it? I don't know how this plays out. I don't know if they do like they shut down the economy or we get some ridiculous recession that people are calling about. I don't know. I don't know how to get to 50. Um, 50 is really, really low. 70 is like the new 50, or 80 is the new 50, given inflation that's been in the system the past couple of years. I'm surprised at the level that we're at today, even. I would think that we're going to be hanging around 90, $100, $120 a barrel oil, given how much inflation's in the system. I mean, everything in my food has gone way up, but yet gasoline is still very cheap. We're at $2.59 when I last filled up the tank. I think that's incredibly cheap. This CRB commodities chart is sure something as it is reaccelerating to the upside. I like the big buying pressure, small selling pressure. Here we go. We're starting to rip here in commodities. Great looking chart here. I'm fertilizing my portfolio. Are you? So the ASC fertilizer index is ready to break out here at any second. We've got the shakeout before the breakout. That's that false breakdown before you rip to the upside. This is also an indication of what I think is coming. I saw a chart that someone was charting that the Baltic Dry Index had broken down, and it's like, well, it's going to break back up because fertilizer looks good. Iron ore looks like it looks pretty good, and I'll show you a chart on iron ore here later. And then also, if you look at the Newcastle coal futures, they look like they're trying to bottom here too. And that's what all shipping for dry bulk. U.S. production is likely already in decline, says Christine. I can see a 250,000 barrel per day correction coming this year as the state data forces the EIA to make revisions. And this is frac crews. Look at this. Look how low we are in frac crews. Oh my goodness. This is basically completing those drilled uncompleted wells. Yeah, look at that. It's way down. It's way down. We're going to see a decline in production here unless prices start to move on higher. This is what I think is occurring, guys. I think that they're playing paper market games in the oil market. That's why we're getting these ridiculously low ratios in the oil to gold ratio and stuff like that. I'm going to show you that later. And we're seeing a pullback on drilling. Rig counts dropping. We're pulling back on frac spreads here, all this stuff. And I think OPEC is basically saying, I'm not going to increase production until you increase the price. And it's like a face-off between paper market games and OPEC. And that's, they're kind of going at it after each other. Permian rigs at a new cycle low. This is for rigs in the Permian here, new cycle low. So we're pulling back on production. Drill, baby, drill. This is more like undrill, baby, undrill. The rig count's falling. Prices are too low. OPEC is holding its ground. And now we've got basically I'll say something on the lines of OPEC versus the paper markets. That's what I'll say. To cover 37 trillion public debt, 237.2 million gold ounces held by the U.S. needs to be revalued to $156,000 an ounce. $156,000 an ounce to go gold back. Think that's going to happen? I don't know. We'll see. Dave Collins says the Shiller Cape shows the 1880 to 1990 average was about 12. The low was 6 in 1920 and 1981, and it currently sits at 38. Can an equity bull market take me off this precipice? Why should I own any standard equities? I don't. 38 is very expensive, and if you look in history, well, it usually falls. We had a double top here potentially, and I don't like it. I don't like buying stuff that's expensive here. Don't like it. Already talked about that one. Christine says a leader at the AAPG just DM'd to ask why I said that oil below $80 a barrel was destabilizing. Here's my response. I could have kept going, but needed to refill my coffee. So let's read what she has to say about $80 and below being destabilizing. This is Christine saying this. I'll just move it down a teeny bit here. We've been in a highly inflationary environment since 2019. $65 in 2019 is $80 today. Those numbers don't work for many operators. If you don't believe me, then review the last year of Dallas Fed surveys. 40% of respondents already say they are in production decline, and I guarantee you that many of the largest companies are kicking themselves for too much growth in 23 and 24. The industry isn't healthy. Halliburton laid off about 6,000 people last year. Shell laid off about 15 to 20% of their upstream. The list goes on and on. The US and Canada are both cannibalizing their oil and gas industry by scaling too hard since 2022 in an attempt to put lipstick on a pig and be attractive as a takeover candidate. We aren't operating like we want to be a healthy place to work for the next 20 or 40 years. Maximizing net present value but lowering EUR. Thank you attending my TED Talk. Another thing that she says, another key element, new Permian wells are now producing less oil per lateral foot on new wells as operators have used up most of their tier 1 acreage. They have also used up the cheapest water disposal locations, which is why since 2017 oil production increased by 80%, water by 200%, and seismicity by 1,000%. So that's what's going on in her opinion, why 80 and below is destabilizing. Here's a lot of ratio charts and or normal charts that I was sharing here. This is the precious metals chart priced in dollars. We can see a big squeeze in platinum futures priced in dollars. We've got the squeeze going on. In palladium, we've got the retest. So each of these times we broke out, did a retest, broke out, did a retest, and we're sitting on top of support for palladium. Well, gold's just ripping in dollars. That's a current breakout and move. And then we've got silver that has recently broken out of its big cup and handle to the upside. I would say that platinum is the earliest in its move. Silver is the second earliest in its move. Palladium just kind of, it's more towards support. Gold's full steam run on ahead. Platinum ratios against gold and silver. I like looking at ratios. Some people don't like using ratios. I think that they tell if something's cheap in relationship to history. So here it is. We are very low at 0.3 for platinum to gold ratio. I think this is a really cheap location for platinum. You can also see that we've recently had a squeeze up and a breakout, and we're doing a retest right here. Very, very cheap for platinum versus gold. This is platinum versus silver, another one that we're extremely cheap against. So platinum's extremely cheap against silver. Some people I've heard say that silver's the cheapest commodity or cheapest asset in the world. I would argue that platinum is cheaper than silver off this ratio compared to history going back to 1980s. We have a falling wedge right into a corner. If we zoom in on that corner, we've broken out of that downtrend. And I do think that this is a good location to be looking for a long-term investor. Natural gas versus other asset classes. Nat gas was and maybe still be one of the cheapest assets out there in the world. Nat gas is definitely cheaper than silver from that perspective, but you can see how low we are, and we are starting to come on up for natural gas versus copper in this one. We've got natural gas versus palladium. That's coming from off of really low bottoms here. You can see in history how high it's gotten in 2005-6 and where we are today. Natural gas versus platinum, it's starting to work its way on up. Nat gas is starting to turn up against everything. And then natural gas versus uranium, that's turned up and it is ripping against uranium. I think that we could go all the way to the top here before natural gas becomes overpriced against all of these other asset classes. It has a huge runway ahead of it against all these other asset classes. Here's some more. Natural gas versus crude oil, that's broken out of its bottom and it's starting to head higher from a very low ratio. You can see where some of these peaks were, but even if we get to 0.2, that's still about a 4x from where we are today. Coming back, natural gas against Baltic Dry Index has been coming back up. Baltic Dry Index is also one of the cheapest areas in the market right now. Shipping is the cheapest area in the market, Baltic Dry Index. So we'll look at some of the investment opportunities in the Baltic Dry Index or on the website. And we've obviously been participating in the Baltic Dry Index because of how cheap it is. This is natural gas versus Dow Jones. We're real cheap. This circle is roughly where I think we're at for this circle. So think of breakout, retest, and then I think we're going to have probably a run ahead of us in natural gas for probably some years, maybe even a decade. And here's natural gas versus gold. It's coming from an incredibly cheap location. Looking back in history, we went all the way up to 0.036, and now we're at 0.001. That is a 36x difference. If we were to reach that high again, I don't know if we're going to go that high, but right now, that gas is real cheap against all these other asset classes, and it has been outperforming recently. Here is oil versus Dow Jones. I know we've had some developments. We had a kind of a breakout in crude oil. It's pulled back this past week. Falling wedge, falling wedge. If we zoom in on the right-hand side, here we are breaking out, doing a retest. Hopefully crude oil can start to outperform Dow Jones. Looking here on Dow Jones versus crude oil, I flipped them. We've got a shoulder, head, shoulder topping pattern that we could potentially break. And if we zoom in, I think this is the same type. The white downtrend line is the blue downtrend line, and then we've got the circle and the circle there. That's what I think is going on. And then I think we could compress lower where oil can outperform Dow Jones. We zoom in, we had a pull down and we're at support, and we're finding support at this current moment here. And then I think it will eventually work its way lower again. This is oil to gold ratio update. So again, we've seen crude oil do very well. It kind of popped out of its pattern and then it pulled back to do a retest. And this is just kind of an update. We have that falling wedge. We zoom in. We're still within the falling wedge, depending on how you draw this. You can draw it, cut through this, and hit some of these other lines here. And we would be doing a retest there if you did that. But we could still say that if you were to touch these guys more on the upper end, are still in the pattern, potentially. We have a shoulder, head, shoulder. If you price it with gold first against crude oil, and then we've broken through the uptrend line, and we are probably doing a retest here before we roll on over. So that's positive for crude oil against gold. Here's iron ore. It says, I say iron ore could be doing the Livermore accumulation cylinder. This would be from making all of the things we need for energy, like transmission lines, solar, wind, nuclear, etc., and our building, all the buildings that we have to build in this big building boom that we've got going on. This could be a Livermore accumulation cylinder. 1, 2, 3, 4, 5, 6, and then 7. We're squeezing into the corner here for iron ore. The Livermore accumulation cylinder looks like this, where you get a 1, 2, 3, 4, 5, 6, 7, and then you break out into a huge bull market which could be a pretty long time. So that's what we're seeing there off of Livermore accumulation cylinder, and that's kind of what I think this could be developing. Then we just need a break here. That will also push the Baltic Dry Index up. And if coal goes up and other things that are shipped, the fertilizer index looks like it was breaking out too. Gold broke out of its blue 13-year cup and handle base 14 months ago. The breakout was very likely to succeed since gold back then was only 15 months into its new 8-year cycle. A breakout attempt that occurs early in a cycle usually succeeds. And when gold has a massive breakout, silver should follow shortly, which it predictably also did a quarter after gold. The gold had its 8-year cycle low back in 2022, which I called in real time, which means it is only 2.5 years into this present 8-year cycle. And gold also has a monumental breakout from the blue 13-year cup and handle base only 14 months ago. With a bull market backdrop like that, do not listen to the ones calling for outrageously low numbers during the counter trend decline, since gold is now in a resumed raging bull market. After a weekly cycle decline, there always comes a weekly cycle advance. Also, many are only into the short-term price action. Beware of that. One can not only look at price action short-term in order to understand where things are going. Having done big picture charting for decades, it is easy to see that it is a vital part of the puzzle. Furthermore, It is important to realize that many narratives are just made up selling themselves narratives. They are not produced to help you or to give you an honest view of things. They are only for getting attention, or sometimes they are just a result of not knowing better. Plus, the sentiment needs to be at the wrong extreme for a turn to happen, i.e., most have to be wrong for a turn to occur. For example, for a meaningful low to happen, most have to be bearish at the turn, i.e., they have to be wrong. Think about that. Think about what this really means for how you spend your time. The breakout calls for the breakout below was made here and very clear, and hoping you made the most of it. Also said all the way all the way up that it looked like gold was not going to backtest, and it has not, which many have called for. So silver breakout, gold breakout, it's ripping. And a lot of people are getting this wrong. They're focusing on the short term. Let it go, guys. Let it make you money. Just let these things rip. They've broken out on the long-term big picture views, and I think they will continue to go higher. This is your commodity precious metals bull market that's in full effect. Morgan Housel says, study successful investors and you'll notice a common denominator. They are masters of psychology. They can't control the market, but they have complete control over the gray matter between their ears. That's what you need to work on. Master of psychology. Guppy says we're gonna have Brazilian interest rates and Brazilian equity multiples. A quick update. So this is the deficit projection scenarios of the trillions that are coming, and this is the interest expense and the projections going forward. And this is basically your problem. That's the problem, and why interest rates are going to go way up. DXY and silver, great time to be long silver. I agree. There's the big picture view. We've got the dollar rolling over. When the dollar rolls over, anything that's priced in dollars will go up in price, silver included, and a bunch of other commodities. And that's why we're seeing fertilizers break out. That's why we're seeing iron ore that has a big accumulation cylinder. Gold's breaking out. Silver is it's ready to rip. It's all based off the dollar. And money flows from that dollar. But that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. But that's all I've got for today, and we'll catch you next time. This is Finding Value.